Investment banks have made it clear. Silver is no longer a normal market. Pause for a moment and answer this question in your mind. If silver were merely a speculative metal inflated by hype, why would governments intervene so that it is not allowed to fall in price? If silver were a bubble, why wouldn't major banks say stay away, but instead say the market structure has changed? And if everything were still normal, why would 2026 be the year when banks, governments, and large corporations all act simultaneously, rather than merely speak out? When too many powerful actors react at the same time, the issue is no longer about price, but about the nature of the game itself. For decades, silver was traded like a traditional commodity. Scarcity pushed prices up, surplus pushed them down, cycles were clear, and the logic was familiar. But as 2026 approaches, that logic has begun to fracture. In its late 2025 Commodities Outlook report, Citigroup delivered a brief but extremely weighty assessment. The silver market is increasingly policy-driven rather than market-driven. This is not a price forecast. It is a declaration that the rules of the game have changed. When a market becomes policy-driven, three dangerous things happen simultaneously. First, price is no longer an honest signal. Prices may hold not because risk has disappeared, but because someone does not allow them to collapse. Second, volatility becomes harder to predict, not easier. Price pressure compressed on one side accumulates force, and when it releases, it does so rapidly and violently. Third, and most importantly, those who trade using old habits will be the first to suffer losses. This assessment does not stand alone. In its Commodities Outlook 2026, Goldman Sachs emphasized a physical, not financial, constraint. Silver faces structurally constrained supply elasticity. Put plainly, even if prices rise, additional silver supply cannot be created quickly. More than 70% of silver is a byproduct of copper and zinc mining. You cannot simply flip a switch to mine more silver because prices increase. What are the consequences? Prices can rise very rapidly during supply shortages, but also fall very deeply when speculative capital withdraws. Goldman Sachs describes this as an environment where volatility is not an accident, but the default state. And here is the key point you must remember for all of 2026. The market can be right, but your account can still be wrong, very wrong. Banks are not telling you to buy silver. They are not telling you to sell silver either. They are telling you something far more dangerous. If you approach silver with old thinking, you are playing a game whose rules have changed, without prior notice. In the next section, we will go deeper to the moment when governments formally place silver within a national security framework and what that means for prices, volatility, and those holding silver in 2026. If you want to continue understanding the real game unfolding behind the silver market, subscribe to the channel and turn on notifications. These analyses do not chase headlines, but they are often what you need before the market forces you to react. Part 2: Government and National Security. When prices are no longer allowed to fall, there is a very clear boundary in the history of commodity markets. It is the moment when a metal is no longer viewed as a tradable asset, but as an element of national security. For silver, that boundary has been crossed. In November 2025, the U.S. Geological Survey included silver for the first time on its list of critical minerals. This is not an academic list. It is a list that activates special state intervention mechanisms, priority permitting, capital support, strategic stockpiling, and, in certain situations, indirect price controls. The stated reason is explicit. Silver is an essential material for defense, energy transition, and advanced electronics. In other words, silver is no longer evaluated primarily by its investment role, but by its ability to sustain system functionality. This shift was quickly embedded into a broader legal framework through Section 232, enforced by the U.S. Department of Commerce. Under this provision, imports of strategic minerals can be deemed a national security threat, allowing the government to apply measures such as adjusted tariffs or trade restrictions. What matters here is not a specific policy, but the mindset behind the policy. When a government says, "We cannot allow this supply chain to be disrupted," it also means that the price of that resource is no longer allowed to collapse freely the way it once could. This is precisely the context behind J.D. Vance's attention-grabbing statement before representatives of multiple countries. when he emphasized that reference prices would be maintained through flexible tariff instruments in order to protect the integrity of strategic mineral markets. Pause here for a moment, because this point is very easy to misunderstand. A policy price floor does not exist to enrich investors. It exists so that mines do not shut down, factories do not run out of raw materials, national defense does not become dependent on external supply, governments protect industries, not individual trading positions. And this is the dangerous paradox facing the market in 2026. Prices may be supported at certain levels, but short-term volatility can still be extremely violent. Drops of 20 to 30% in a short period are not eliminated, only confined within a policy corridor. What does this mean for silver holders? It means you cannot assume that a policy floor will save you if you buy at the wrong time. You also cannot rely on the old logic that the market will gently self-correct when national security enters the game. The market becomes less forgiving, not safer. Governments do not behave like traders. They behave like systemic risk managers. And in that process, those standing in the wrong position are often not warned in advance. Part 3. Large corporations, not speculating. They are locking in supply. If you want to know where silver is really heading in 2026, don't look at the charts first. Look at the companies that cannot afford to be wrong. Large corporations do not trade silver for short-term profit. They are not allowed to misjudge supply. And for that reason, their behavior is more reliable than any price forecast. In U.S. programs for strategic mineral reserves and supply assurance, the name that has drawn the most attention from analysts is not a mining company, but Google. Google does not mine. Google does not sell silver. Google has no speculative incentive. But Google has one very specific fear: not having enough silver to power its AI future. In next-generation data centers, each AI server consumes far more silver than a traditional server. Silver is used in high-speed circuitry, signal transmission systems, heat-resistant, stable conductive contact layers. Without silver, AI does not run. And without AI, Google loses its core competitive advantage. So when Google participates in long-term mineral assurance programs, it is not betting on price. It is sending a very clear message to the market. We are not confident that we will be able to buy enough silver on the open market in the future. This story does not stop with technology. Boeing and General Motors also appear within the same mineral supply assurance ecosystem. These are different industries, but they share one dangerous commonality: aerospace and defense. Electric vehicle manufacturing both cannot substitute silver with other materials in the short term. For Boeing, silver is used in radar systems, avionics, guidance, and communications equipment. For General Motors, silver is a critical component in batteries of vehicle electrical systems. Charging infrastructure. When these companies are willing to pay higher costs to secure access to silver, it reveals a very cold reality. Their greatest risk is not high prices, but not being able to buy at all. This is the point many retail investors often miss. Financial markets are accustomed to viewing everything through the lens of price. Operating companies view the world through the lens of access. And when large corporations begin pulling silver out of the free market and into long-term agreements, what happens? The amount of freely traded silver declines, physical liquidity thins, prices become more sensitive to every shock. This does not guarantee that prices will only move upward, but it guarantees something else. Volatility will become more violent and more unpredictable. Large corporations do not need a beautiful market. They need a market where supply is predictable for themselves. And once they have locked in their supply, the rest of the market must share a smaller remaining slice. In the next section, we will look at the other side of the picture. Warnings from major financial institutions that the silver market is showing signs of a short-term bubble, and why these warnings do not contradict what governments and corporations are doing, but instead reinforce each other in a deeply troubling way. Part 4. Warnings from the pessimistic side. The signs of a bubble are real. For an analysis to be considered credible, it cannot selectively listen only to what it wants to hear. And with silver in 2026, there is a truth that must be put on the table plainly. Not all financial institutions believe that silver's rally is safe. In its early 2026 strategy report, Bank of America placed silver in a very striking position. Silver currently ranks at the top for bubble-like price dynamics. Silver currently tops the list of assets exhibiting bubble-like price behavior. What matters is that Bank of America is not saying silver is worthless. They are not denying its industrial role, nor are they dismissing geopolitical factors. What they are warning about is how the market is trading silver, not silver itself. From Bank of America's perspective, the recent surge shows many familiar characteristics: rapid inflows of hot money, rising leverage, widespread fear of missing out, FOMO, and the belief that policy will always stand behind prices. This is precisely the environment in which prices can run far beyond what the short-term market can withstand, even if the long-term story remains intact. This view is echoed by JP Morgan, where strategist Marko Kolanovic issued a more technical warning. Silver's recent rally shows characteristics of leverage-driven excess. Silver's recent rise displays features of excess driven by leverage. Pause on the phrase leverage-driven. It means not everyone is buying silver because they need silver. Many are buying because they believe prices will continue to rise rapidly, and once leverage enters the picture, the market no longer operates on the logic of right or wrong, but on the logic of who can endure longer. This is where many retail investors misjudge the situation. They hear, governments are protecting the industry, corporations are locking in supply, silver is a strategic resource, and they reach a dangerous conclusion. Then prices can't possibly fall hard. Reality is exactly the opposite. Markets with the strongest macro narratives are often the ones that suffer the most painful short-term crashes. History has shown, .com had a real technology story. Real estate had a real demographic story. Renewable energy has a real transition story, but leverage applied at the wrong time always destroys participants before the long-term story has a chance to play out. With silver in 2026, the picture becomes particularly dangerous because two forces coexist. 1. The long-term story is real, supply shortages, strategic importance, geopolitics. 2. Short-term behavior is highly speculative, FOMO, margin, headline chasing. These two forces do not cancel each other out. They stack on top of one another, creating a market where the long-term direction may be correct, but the path is extremely brutal. That is why the warnings from Bank of America and JP Morgan do not contradict what governments and corporations are doing. On the contrary, they reinforce each other in a deeply troubling way. The system is preparing for long-term scarcity, while the market is trading as if everything will only go up. And it is precisely the gap between these two realities where the greatest risks are formed. In the next section, we will touch on a factor even more dangerous than speculative bubbles: a massive data blind spot in global silver supply-demand statistics, directly related to military consumption, something the market barely sees, yet which could completely change how we understand the true scarcity of silver. Part 5: the dangerous blind spot. Military silver is not counted. There is a question that very few people in the silver market dare to ask directly. If silver is truly scarce, how scarce is it? Really? The common answer you usually hear comes from annual supply-demand figures and widely cited aggregate reports. But the problem is this: those numbers do not reflect the full picture. According to official reports from the Silver Institute, global supply-demand statistics do not include military consumption, not because the data is unimportant, but because there is no public data available to include. And here is the detail that makes every model fragile. The U.S. Department of Defense stopped publishing silver consumption data in 1996. There was no explanatory announcement, no replacement framework. The data simply disappeared. For nearly 3 decades since then, the silver consumption of the world's largest military has not appeared in any supply-demand balance used by the market. Pause for a moment to understand what this means. Silver is used in radar and guidance systems, satellites and military communications, batteries, circuitry, and sensors, cruise missiles, fighter aircraft, and warships. And unlike consumer electronics, silver used in weapons is not recycled. It is destroyed, buried, or permanently lost after use. Yet not a single ounce of this is counted as official demand. This creates a dangerous paradox. The market believes the deficit is X, while the real number could be X plus an entirely unseen component. A former U.S. defense official once remarked, according to international financial press sources, unnamed, if the public had access to the real consumption figures, pricing assumptions would change overnight. This is the systemic blind spot. And every market with a large blind spot carries two parallel risks. 1. Underpricing the risk of long-term scarcity. 2. Misjudging the scale of short-term volatility with silver. Both risks are present simultaneously. On one hand, the market may not be fully pricing in the amount of silver that has been and continues to be consumed by the defense sector over decades. On the other hand, because the data is opaque, every correction can occur abruptly when a new piece of information or a policy action reveals part of the hidden truth. This leads to a cold but extremely important conclusion for 2026. If the input data is incomplete, overconfidence becomes the investor's greatest enemy. You cannot build a safe trading strategy on figures that do not reflect the full scope of real demand. And you should be even less inclined to use leverage in a market where a large portion of demand lies outside visible data. In the next section, we will synthesize everything that has been analyzed to deliver a direct warning message to those holding silver in 2026. Who should stay put, who should be cautious, and why this is not a market for every type of investor. Part 6 Warning Message for Silver Holders in 2026. After everything we have analyzed so far, one thing must be stated clearly and without evasion. Silver in 2026 is not a simple up or down story. It is a test of your position within the system. Governments are protecting supply chains. Corporations are locking in raw materials. Banks are warning about volatility and leverage. Market data is incomplete. In an environment like this, the biggest mistake is not choosing the wrong direction, but choosing the wrong way to participate. Who should not participate in silver in 2026? Be honest with yourself. If you fall into any of the following groups, silver in 2026 is not for you. Those using high leverage, margin, or short-term futures, those trading based on hot headlines, political statements, social media rumors, those who believe, because there is a price floor, prices cannot fall deeply. A policy price floor does not protect individual accounts. It protects production systems and national security. A 20 to 30% drop within a few days is entirely possible, even in a market that is backed by the government. Who may be suited for silver in 2026? Conversely, silver in 2026 is truly suitable only for a very specific group. Those who view silver as systemic insurance, not a tool for quick profits. Those who accept severe volatility, long holding periods, liquidity that is not always favorable. Those who do not need to sell immediately during market panic. In other words, silver in 2026 does not reward fast reflexes. It rewards those who position themselves correctly and are not forced to act. The most dangerous misunderstanding: many retail investors are making a fatal mistake. They see government intervention and assume risk has decreased. In reality, risk has only changed form. Free market risk, policy risk, price risk, volatility risk, supply risk, allocation risk. These risks are harder to see, but not smaller. And because they are harder to see, they often cause greater damage to the unprepared. Survival principles for 2026. If there is one concise rulebook for silver in 2026, it is this. 1. Do not go all in, because you do not see the full data. 2. Do not use leverage, because volatility is not on your side. 3. Do not trade emotionally, because the market will not give you time to recover. 4. Differentiate strategic accumulation from price speculation. Silver may be right, but the market can still make you wrong if you stand in the wrong place. In the final conclusion, we will answer the most important question of all. After all the signals from banks, governments, and corporations, is silver in 2026 ultimately an asset or a minefield? And where should you stand so that you do not become the one who pays the price for your own misunderstanding? Part 7. So will silver in 2026 be an asset or a minefield? If you look back at everything we have just covered, one thing is nearly undeniable. Never in modern history has silver received so many conflicting signals at the same time. Banks say the market structure has changed. Governments say silver is a national security issue. Corporations say we will not wait for the market. We are locking in supply. And at the same time, financial institutions warn leverage and short-term bubbles are real. These four signals do not contradict one another. They describe four different layers of the same reality. And it is precisely this overlap that makes silver in 2026 especially dangerous if misunderstood. Silver is no longer a forgotten metal, but it is also not a safe haven for every investor. It sits on a very fragile boundary between policy and market, strategic accumulation and price speculation, physical scarcity, and financial volatility. In a market like this, the most important question is not how high will silver prices go, but rather, are you acting like a bank, analyzing structure and managing risk? A corporation, preparing for the worst-case scenario in supply? Or a retail investor, reacting to headlines and emotions? Silver in 2026 will not be forgiving of confusion. It can reward those who correctly understand its role within the system. But it is equally ready to punish those who approach it with outdated thinking. If there is one thing that is certain after all these analyses, it is this. Silver is not merely a bubble, but it is also not a game for the undisciplined. Metals that are brought into a national security framework do not rise because of expectations. They move because of conflicts of interest between layers of power. And within those conflicts, those who do not understand the rules of the game are usually the ones who pay the highest tuition. If you have followed along to this point, it shows that you are not searching for a simple answer. You are trying to understand the system before it forces you to react. If you want to continue with analyses like this, no hype, no FOMO, no chasing headlines. Subscribe to the channel and turn on notifications. The algorithm may not favor this type of content, but during periods of intense market volatility, it is precisely these slow and cold perspectives that help you stay standing. We will return to silver again, but at deeper layers, where price is no longer the central story, but who controls physical flows, who controls risk, and who is ultimately forced to pay the price. See you in the next video. And don't forget to subscribe using the button below.